BlackRock, DTCC, Fidelity. The entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
You said it. You finally said it.
I'm so bullish.
Andy's bullish. I'm bullish. We're bullish. We're on 4th floor today. We're going to be on floor 1, and then we're headed straight to the moon, boys.
All right. We are back. We're live, and never felt better. Bit of a rocky start this morning, but we are live once again. Plenty of updates for you guys, and pretty excited. We've got Matt Hougan from Bitwise, the CIO, the Chief Investment Officer of Bitwise, coming on the show later today with tons of news in the neo finance space to talk about. Obviously, you guys have seen BlackRock getting into Uniswap with their BitOld product, also Apollo getting into Morpho. So these guys are starting to adopt DeFi technologies, and it's happening sooner than anyone thought it was going to happen. So Matt is at the center of all of this, and he actually believes this is what is going to pull us out of the bear market. He's going to be on in about 15 minutes, and we're going to chop it up with Matt Hougan from Bitwise. But first, we've got some news that we want to go over with you guys. So let's do it. Let's bring up some headlines. We've got the payments firm Level closing their $7 million seed round. This one was led by our friends over at Galaxy Ventures. Galaxy's on an absolute tear. They did 10 bin, and now they are working with Level. And if you had listened to our chat with the Galaxy Ventures team, I believe this would have been 2 weeks ago, maybe 3 weeks ago. Yeah, we did have Will Newell on the show, and he told us about another company that he was particularly excited about. I have a feeling he was talking about Level, which announced their $7 million seed round today. Level enables businesses to process both fiat and stablecoin payments. Again, we're seeing teams on both sides of the aisle. These companies are helping to cross the chasm. They're helping bridge the gap. We're seeing this in the RWA space, right? With native issuance, digital twin, the tokenization teams working on both the equities and the crypto side. And now, we have Level, which is a payments company that it's working on both fiat and stable coins. Again, sitting in the middle and able to service both sides of the market. Founded by ex-AQR trader and spun out of Galaxy Digital. Their team is from PayPal, Deutsche, and BlackRock, as well as other major financial institutions. The $7 million seed round will expand their product suite, including B2B cross-border transfers, payment processing, and lending solutions across London, New York, Canada, and Switzerland. So shout out to the Level guys. I think we're going to see more of this, and we're going to see more Forex as well. I think that is an underrated part of this stablecoin business, but obviously stablecoins in general are exploding. We've seen a lot of B2B, business to business stablecoin payments happen. A lot of people are starting to pay at point of sale with more stablecoins and crypto debit cards. And then obviously the remittance industry is actually still quite early. The global cross-border payments market is demonstrating explosive growth. Transaction volumes are projected to reach $320 trillion by 2032, but global payments remain constrained by legacy financial infrastructure. And so we're going to see Level play in this market as well. Shout out to those guys. Congrats on the Level $7 million seed round led by Galaxy Ventures. Next up, Wintermute. Wintermute launches institutional tokenized gold trading. You guys know Wintermute good and well. People like to say they are responsible for pretty much everything that happens in the market. Them and Jump Trading are some of the most villainous characters. Obviously, they're not villains here. They do good work. They're market makers, but a lot of this things happens behind the scenes. You know, these are the guys making the markets. Most of retail is out there taking the markets. And so you just got to take what Wintermute gives you, which is why they catch a lot of flack. But they're getting into gold, which is no surprise if you've been tracking Tether and the amount of tokenized gold products out there. And so what Wintermute plans to do is they expect the tokenized gold market to reach $15 billion in 2026. This is a result of tokenized more of these gold products, as well as the gold market just continuing to rip, which is why we've seen a lot of growth happen in this industry up until now. Wintermute is going to be working on an OTC institution-grade trading product. And so this is what is going to target hedge funds, corporate investors, and minimize price impact for large trades. So these are people and market participants trading large sums of gold. The settlement obviously is a difficult thing, particularly with gold, because it's difficult to move from place to place. Paper contracts and derivatives have made that particularly easy, but settlement time is still a blocker. And so tokenized products bring settlement time all the way down to nil. Instant settlement for tokenized gold. And this is representing gold that's held in vaults, enabling electronic settlement, simplified market access through blockchain technology. Tokenized gold is one of the things that I think we're going to see happen a lot more. It's going to be a lot more growth here. We've been talking a lot about tokenized equities, money markets, these sorts of things as forms of collateral in vaults and other trading strategies. But you have this permissioned layer that prohibits a lot of retail investors from buying those products because they are securities. Gold, on the other hand, is a commodity. Anyone can buy it, even in tokenized form. I believe we're going to see a lot more tokenized gold used as collateral in DeFi and NeoFi going forward. Moving right along, we've got Banksa and Ton partnering to enable stablecoin payments for APAC businesses. Integration should allow small, medium enterprises to process cross-border transactions and B2B settlements using Ton's blockchain architecture. Obviously, Ton being the Telegram blockchain. Banksa is licensed in US, Europe, UK, Canada, and they are expanding Ton's global payment network. Recent Ton Pay was launched on Telegram, and obviously Telegram's got massive distribution, 1.1 billion users. I think Telegram is moving a little bit faster than some of the other messaging and social media platforms. We're also hearing that X is going to be launching a financial services component to the social media platform X. And so this, I think, is very, very similar. We're going to be seeing a lot more of this. And social media companies are getting into the financial services game. Anyone with massive distribution can stand to benefit from financial products and services because the lifetime value of customers is so high and they already own the relationship with the end customer. I'm sure you guys feel it. You hop on your phone. Next thing you know, you hopped on to check an email. Next thing you know, you're checking Twitter or you're checking Instagram. It's just second nature at this point. And that's why it makes sense for more of the high value products and services to be integrated more deeply, at least from a capitalistic perspective. That is what is going to maximize the amount of value that you're squeezing out of all of the attention in the app. WhatsApp, I believe, already has payment embedded into it. Telegram is now partnering with Banksa to enable more financial products and services. Mr. Beast is launching a financial product and service component to its business. And X is doing the same. This is all a result of the distribution that they already have, building and verticalizing more of the business stack and integrate it into their existing distribution. It's the position that they find themselves in. So we're going to keep moving along. Let's see what we've got up next. Yes, China is running the EV playbook on humanoid robots, and it's working. This is insane. I wish we had the video to show you guys, but I don't think we do. So we're just gonna talk about it. There was a video that went pretty viral of these humanoid robots dancing. And so in 2025, last year, they did a similar ceremony where these things were, we talked about it yesterday on the stream, they were actually like still robotic looking, kind of clunky, kind of robotic movements, not very fluid. They did this same ceremony show unveiling of like the latest years of this humanoid robot. And it was incredible how human-like these things are. They were dancing. They were practicing kung fu, martial arts, and all of this was with humans and robots on the stage together. And so I think these things were particularly small at first. And it just goes to show that these things are going to scale up incredibly fast. The difference between 2025 when they did this and 2026 was basically the difference between like ChatGPT 2.0 and ChatGPT like 5.0, whatever we're on now. It was an incredible step function and increase in the effectiveness and productivity of these things. Now it actually looks like they can coexist with humans, which is an insane thing to even say and think. But that was the impression that I got watching this. We're going to be seeing a lot more of this. Obviously, Elon is working on his own Optimus humanoid robots. They've shut down certain models of Tesla so they can focus on the Optimus robots. They are also, they've also, at least Elon has been particularly fascinated by the hand of these Optimus robots and how difficult it is to build a good hand. And so I did notice in these Chinese robots that they had almost like a mitten or a glove on. And so it did not have the same kind of dexterity that humans' hands have. And so I think that would open up another set of use cases. China is shipping these things extremely fast. They're innovating very quickly. And from what I'm hearing, China is also going to be selling these things at a very affordable price point, which I think is going to open them up to end consumers very, very quickly. We're going to be seeing a lot of these. Maybe they don't have all of the robustness of all of the tasks that you could imagine, but they are certainly coming. And I think once Elon gets Optimus out the door, it's going to be a little bit of a higher price point, but we are going to see a lot of those and apply that technology to a lot of different use cases. There's one last thing about the robotic industry that we're seeing progress that I want to mention, which is that if you guys have been watching some of the podcasts that we've done previously with Arthur Hayes, you would have seen that we had Nils from the Ayuki project. The Ayuki company is one of the few companies out there that's mixing blockchain and robotics. I had mentioned them a couple of weeks ago on the show. Probably should have been a lot louder about it because that token is on an absolute tear. I see we've got the video now. Why don't we cut to the video so you guys can see what I'm talking about with these robots? robots are. If I'm a parent of one of these kids, like, do I want them on this, like, that close to an experimental robot doing kung fu? These things are so light on their feet. They have so much dexterity. The agility is incredible. They're doing backflips. Oh my god. They kind of stutter step when they land these backflips. It's not super, super smooth. But if you guys see the comparison between 2025 and 26, it's night and day. These things are actually good now. These kids do a great job. So I think I've seen a humanoid robot, but I haven't really interacted with one. I have interacted with some of those robotic dogs. If you guys have seen those Boston Dynamic dogs, it is very unnatural. There's an interesting phenomenon actually about this though, which is that, you know, obviously my age, I've interacted with plenty of real dogs, as well as real humans. And so they did a study with babies, and they checked whether babies could tell the difference, and they really couldn't. I've also heard stories that babies aren't afraid of snakes. You can actually put a baby right next to a snake. It's totally unfazed. It kind of pets it. It thinks it's cute. It doesn't have this innate fear of this thing like us humans do. Yeah, why don't we cut back to the article? And so I think the reason why this feels very unnatural to us now is because we've got, you know, decades under our belt of time in which we've interacted with humans and we've interacted with you know, real animals. So when we're faced with an artificial humanoid robot or an artificial human or a robotic dog, it feels very different from what we're accustomed to. Smaller people or people that will grow up and these things will already be ubiquitous, working in factories or teaching your kids in school. If your kid is coming up through, you know, their life and their experience and they're accustomed to robotic dogs and humanoids, they're going to have a very, very different relationship with them. It won't feel unnatural like it feels to us. It'll feel like they're interacting with someone or something that feels very familiar and very natural, which is going to be a very strange thing as this continues to develop. It's pretty a fascinating development. So how am I getting exposure to this? I have bought some Ayuki because Nils came on the show and he talked about it with Arthur Hayes, and it's doing quite well. So take a look, do your own research, not financial advice. We've got one more headline before we get to our first guest. Shout out to the man, Dragonfly, founder and investor Haseeb. These guys closed their fourth fund at $650 million. Who said that VC was cooked? Because this was raised during a bear market. You guys seen the fear and greed index at extreme fear. It was pretty much as fearful as it could possibly be. Dragonfly's been around for a long time. They're one of the best VCs in the space, constantly staying steadfast in the vision that they have for the space overall. They're also not dissuaded by the fact that this is a bear market. I think it's pretty clear at this point that we're in this crypto winter phase. If it's a V-shaped recovery or a U-shaped recovery, we don't know, but we're going to find out. And so for Haseeb to raise these kinds of funds, it's pretty incredible. They first raised during 2018 ICO winter. They also raised pre-Luna collapse. And that is where they returned the fund. And so they've continuously, time and time again, been profitable in the space with VC. They're also generating some pretty radical fees, which makes it a tremendous business. Hasib I said that his view is that non-financial crypto has largely failed. So these guys, didn't get wrapped up in the governance and decentralization theater, none of the social creator coin nonsense, none of the meme coin nonsense. These guys stayed steadfast in DeFi and have continued to build throughout the DeFi summer, DeFi renaissance, DeFi 1.0, DeFi 2.0, and what we're calling neo finance, which is the latest iteration of Vitalik calls it low risk DeFi. And it's generally this convergence of legacy finance in the Wall Street cohort merging with a lot of the DeFi OGs. And this is what we're calling neo finance. The financial crypto sector is accelerating rapidly. You see this in stable coins eating more and more of the payments stack. And then obviously all of the mechanisms being built around stable coins, DeFi's rivaling CeFi at scale. Institutions are actively building in this space. Prediction markets are emerging as trusted infrastructure. The Fund 4 thesis is that crypto remains early. Can't really make it simpler than that. They're still early. And so obviously you've got to have some foresight into which phases and sectors are going to appreciate the most. But this is where we're at. Don't get messed up in all of the hype and narrative. Stay steadfast. What works is DeFi, and that is where Dragonfly is continuing to focus on agentic payments, on-chain privacy, tokenization, and expanding financial infrastructure. These are the sectors where crypto largely has found product market fit, and this is where they believe, Dragonfly believes, the best investments will be made, especially when sentiment is weakest. So congrats to Hasib, friend of the show. Always a pleasure when he comes on. We'll be seeing him out in Denver. We'll be talking about the fund and what they plan on doing with the $650 million and where they plan on allocating. All right, guys, that is all we've got in terms of the news and the headlines today. We've got the man, the myth, Matt Hougan. You've seen him on Twitter. We're going to send him in to the green room behind the scenes. He's going to be up in just a moment. And we're going to be talking about several things. Bring the glasses back up here. And so we're going to get him in just a moment. In the meantime, let's go over a bit of what we've got. So Bitwise did see $260 million in flow to on-chain products in a single week. They saw the Solana staking ETP in Europe pulled in $60 million. Generally, we're seeing this convergence between legacy finance and the evolution of DeFi. You guys have heard it several times as we've been talking about it. A lot of the infrastructure on chain did not find product market fit. They're being forced to innovate, and a lot of the legacy financial products are now meeting tokenization where it is, and they're being forced to innovate as well. The market knows where this is heading, and it's heading to tokenization, but it's happening a lot faster than I think a lot of people expected. So we're going to bring up Matt, and we're going to be talking about it. There he is. Without further ado, Matt Hougan, welcome to the show, man.
I'm so excited to be here. Thanks for having me.
Absolutely. I'm glad that you joined. I've been a longtime follower on Twitter. I think you've got a very reasonable, nuanced, and pragmatic approach to the space. And I'm excited to chat about what you guys have going on at Bitwise.
I love it. I appreciate the kind words.
Absolutely. Well, I think there's been two pieces of news as of late that I think would be great to start with that are right at the apex of this convergence. We're seeing some of the DeFi blue chips work with some of the largest financial institutions in the world. It's pretty incredible. And so I'd love to just get your initial reaction to BlackRock working with Uniswap as a liquidity mechanism for their product Biddle. And then also Apollo building on top of Morpho. Your first impressions, your reaction to when you saw this in the news, and we'll dig into some of the nuts and bolts.
Yeah, absolutely massive. I think the market hasn't recognized what a big deal this is. This is the world's largest asset manager integrating with the world's leading decentralized exchange to provide liquidity into BUIDL. A second piece that you didn't mention is the CFO of BlackRock saying they will tokenize all their ETFs in the next 3 to 12 months. And then this massive endorsement by Apollo, which is really like the BlackRock of credit, saying it wants to build on Morpho. It's hard to imagine the scale of the importance. This is really opening the door to institutional DeFi. It's a huge first step. If we were in a bull market, these tokens would be plus 100%. We're not, so they're basically flat. But I really think it's a critical event in the history of DeFi infrastructure. I'm really excited about it.
Yeah. Matt, I was listening to a podcast that you did recently with The Block, and you mentioned this. BlackRock is I think it was the CFO mentioned that they're going to tokenize these ETFs in short time, in 3 to 12 months, which you said is a foregone conclusion. It's basically happening.
Yeah, that's the thing I think the crypto market may miss. When a big bank says 3 to 12 months, those things are already 90% done. This is not an experiment. It's not an idea. This is something that's happening, and they're just aligning it with their marketing calendar. So I was really taken aback by that. Look, we all know Larry Fink, the CEO of BlackRock, has said every fund, every asset, every stock will be tokenized. But I think even me, a bull in this space, thought that was a 5 or 10-year period. Now 5 or 10 years has shrunk to 3 to 12 months. I think it tells you a lot about the pace at which this is moving.
Yeah. The people in the chat, they're asking, this is a permissioned feature, right? And if you look at the BlackRock BUIDL partnership with Uniswap, they're working with Securitize in the middle there to make sure that there's qualified individuals and market participants that are end up getting into the BUIDL fund. How much does the permissioned aspect of these things separate them from the existing DeFi landscape? My impression was that tokenization, one of the biggest value propositions was always composability. So how much are we, kind of tokenizing for tokenizing sake without actually getting the main benefit versus, kind of separating these things out?
Sure. I mean, it would be nice if they YOLO shipped for fully decentralized, no AML, KYC, access to everyone, and they went from 0 to 100 miles an hour overnight. That's not the way that these banks work. So what you're saying is absolutely true. This is permission, it's controlled, it's only institutional investors. It is work. It means that the institutional investors want exposure to this, probably because they want to experiment with looping strategies, maybe because they want to borrow against it as collateral. So I would take it as two things. One, a sign that institutions want to do this, and two, the necessary first step for BlackRock to move into full-blown DeFi. I think if you back up and think about DeFi 3 or 4 years ago, there were like 10 major challenges separating us from disrupting all of finance. There were regulatory challenges, there were bandwidth challenges, there were institutional understanding challenges, and then there were these challenges around AML, KYC, and sort of digital identity. We've knocked down all of those other challenges. That's what this signals. The market is mature enough, it is tested enough that BlackRock is willing to attach its reputation to true decentralized exchange, true DeFi. We still need that last piece of AML, KYC, and decentralized identity before we take over the $10 trillion finance market. But going from 0 to 1 is a much bigger deal than going from 1 to 100. And I think we've gone from like 0 to 10. And I think the rest is just a matter of time. So the critics are right. It's limited, but it's a huge step.
Mm-hmm. I tend to agree with the idea of this being a stepping stone. I think that's the right way to think about it. And I can't help but think that, when we hear Larry Fink talk about tokenization, more recently, he's also talked about basically one chain to rule them all, which I think maybe is an opinion that, his other financial institutional counterparts may not share, but it does signal that he is already thinking about composability to the extent that everything is happening on one unified chain.
Yeah, I think that's reasonable. I think no one knows at this point how it's exactly going to pan out, and my own view is it's more likely to be multi-chain. But I do think he's thinking about where this goes. Look, some context. I come from an ETF background. Maybe I mentioned this on the Block podcast, but I think a lot of the push for BlackRock into tokenization is that they actually missed the ETF game. So BlackRock today is known as the world's largest ETF issuer, but they had to buy the ETF business from Barclays Global Investors after the great financial crisis. So they missed the innovation of ETFs and had to pay up to catch up. And that became a huge business. I think they see tokenization and DeFi as the next wave of that. They're determined not to miss it. Whether it's one chain or multi-chain, almost doesn't matter. What BlackRock thinks, it'll evolve the way it evolves. But it is interesting that they're seeing the big picture. They see how this spans out over time.
Yeah, one of the things that we've noticed on the show just recently has been this transition in previous cycles, which I know you guys and Bitwise have been around for a while. I think since 2017. So you guys have been through multiple cycles. You've seen how the space has evolved. Back in would have been the DeFi summer 2020 era, we started to see a lot of L1s pop up. And this was primarily, around a lot of surge in DeFi as well. And so each chain had kind of the same components with their own skin around them. Every chain had a DEX, every chain had a lend borrow market, and every chain had a yield aggregation service of some kind. It was a very chain-centric way of looking at the world. And now we've noticed that this transition has happened, and it's taken us to more of an asset-centric view of the world. And I'm curious to hear your thoughts on this, because now, we're looking at BUIDL on multiple chains, but now BUIDL has, a DEX, and soon enough, BUIDL will have a lend borrow, I'd imagine. And then, soon enough, it'll have a yield aggregation or preferred vault aggregation service. Do you think that this is the right way to look at this space overall, now that we have some higher quality assets coming into the ecosystem? Or generally kind of tell us about, the pros and cons of what this mental model might give us.
That's a fascinating mental model. I think it's probably accurate, right? It looks a lot more like the traditional market, which is how that is structured. Like there are multiple exchanges where stocks trade, but there is only one stock. There are actually multiple prime brokers lending against that, even though there's one entity. The same is true on the fund side. So I think that is probably the right view of the world. I think, maybe an extension of that is there's probably a power law distribution in terms of DEXs, in terms of lending markets, in terms of vaults. So I'm not sure it will be one to rule them all. I think it's probably more like a classic 70-30-10 or 70-20-10 distribution is what you end up seeing. But look, in the end, the people who have real power in any sort of financial ecosystems are the product providers and then the customer aggregators. The actual infrastructure, it's challenging to compete. So I think when you think about where control lies, I would think in the customer aggregators and the product side as much as in these actual DEXs and such.
So I'd love to dig into that a little bit more. And we've heard this on throughout a variety of different product and market verticals. It's those who own the end customer on the distribution and front end side, and then the bare metal. That is where the money's made. It's this barbell. Everything in the middle tends to get commoditized as people kind of commoditize their complements towards the middle of the stack. And so, as we're looking at the ETF market and some more of the legacy financial products, could you just help? Because a lot of our audience is founders, builders, investors, but crypto native founders, builders, and investors. Could you give us a sense of who currently owns the majority of these two bookends in the legacy finance and ETF world?
Yeah, it's a great question. So in the legacy financial world, it's really the broker dealers and the financial advisors who own all the customers and assets. So it's either Charles Schwab, or if you want to go one layer deeper, it's Morgan Stanley, it's Merrill Lynch, it's UBS, right? They have a huge chunk of the marketing power, and you see that in ETF land, right? ETFs pay effectively a listing fee to be on Charles Schwab to have access to their customers. And sure, like the ETF providers have a certain amount of scale and can build great businesses. But yeah, really where the customers are where it matters. In crypto land, I think people don't pay enough of attention to like the value that Phantom has created or those sorts of wallet-based aggregators. I think there's a huge amount of value there, and you're going to see them monetize that customer relationship and trusted brand over time. Would be my guess.
Yeah. Back in, I think it was 2016 or 2017, there was the original article of the Fat Protocol thesis, which, was kind of the counterpart to the social media rising of these apps capturing. And then people thought that all the value would accrue down to the L1s with gas fees. Shortly thereafter, you saw the Fat App thesis, which kind of flipped the barbell back. I think it's been, now the consensus seems to be what you're saying, which is essentially the fat wallet thesis. This is the portal through which people, and I think people like that too, because it's like, oh, I got a fat wallet.
Sounds great. Yeah.
People want that, right?
Yeah.
And yeah, you're right. Those seem to be the entities that are owning most of the customer relationships. I'd probably say, the wallets and the centralized exchanges at this point are where people see custody, and that's their primary access point.
Yeah, I think that's right. I mean, look, the apps can be fatter than in traditional markets because they're two-sided. So they have supply dynamics and demand dynamics, and that allows them to create more defensible moats. So I don't think the apps get squeezed to nothing. I think they're fatter than they are in the traditional markets. But I think the fat wallet thesis, look, I mean, that's how it plays out in every other ecosystem. I would even say you're seeing it play out here. I mean, the largest primitives in DeFi are tiny right now, right? Uniswap is a $3 billion asset, something like that. Aave $2 billion, massive business, is trading 20x revenues or something like completely silly given the scale of its growth. I think that explains a lot of it. You do have this power in the fat wallet space. Again, the apps don't get squeezed to nothing here because they're two-sided markets. I think that's really an important differentiation. But I do think there's more power in the wallets than maybe most people have historically given credit to.
Yeah, and just to kind of put a number around this, or kind of tie up this thesis, those who own the customer relationships are able to set prices that everyone else is downstream of and can kind of just pick up the pieces afterwards. And so I think wallets are in that position now. And then we've got the other side of the barbell, right? On both the legacy world and also the DeFi neo financial side. In typical blockchain companies, bare metal actually kind of is a somewhat neat term, because ultimately these things are machines, especially in proof of work, even in proof of stake. These things kind of all follow down to the bottom of the stack. But in the legacy financial world, when we're thinking about ETFs, what is considered bare metal as you get, to kind of the two barbell ends of the spectrum?
Yeah, that's a great question. I actually don't know what the right analogy is. Part of me wants to say the index providers, which are the bare metal of the intellectual property behind the ETFs. And if you want to look at a beautiful chart, type in MSCI into Yahoo Finance. That's the leading index provider. It's been one of the best investments in the world over the last 30 years. So I think that is like, ultimately where it boils down to. The barest of bare metals, like the custodians, are just completely commoditized and not interesting. But the IP level at like the index level, it's been a great business to be in for a long time, and they've maybe aggregated more value even than some of the ETF issuers. Look, ETF issuers build deep relationships with customers. At Bitwise, we have thousands of clients. We spend time with them. We cross-sell them from one product to another. We introduce them to crypto. You can have very strong relationships. But I do think the index level in legacy finance is sort of maybe the equivalent of bare metal. It's the IP behind asset management.
And where does Bitwise sit in this? You got Morgan Stanley, Merrill Lynch, and Charles Schwab on the one side. You've got MSCI on the other side. Where does Bitwise's ETF offering sit?
Yeah, I like to think that we cover both the asset manager and the index side. So we run our own indexes for our index products and design the IP there. And then even on the ETFs themselves, we try to differentiate, right? We're a large staking service provider, so we run our own staking service. We integrate more of that, more vertical integration than maybe a traditional asset manager, in part because we want to own the stack, in part because on the index side, we haven't been huge fans of how other people have approached indexing crypto. And in part because I think, people trust is at a premium in crypto for legacy finance coming in. And so the people that we've built relationships over 8 years trust us to do a large part of the asset management business. They sort of want a trusted provider.
Yeah. And we're hearing, as we have more of these conversations with people that are sitting in the middle of these two worlds and able to service both sides, that there's a knowledge gap. There's an education gap. And if you can sit in both sides, understand both of these worlds and speak both languages, you're able to serve as a trusted advisor and a teacher of both of these worlds to ultimately help prepare them for what's coming down the pipeline. Like tokenized ETFs from every ETF from BlackRock is going to be tokenized. How are you helping your clientele prepare for the changes that that causes in the world?
Yeah, I love that. I mean, that's how we built Bitwise, for what it's worth. About half of us come from asset management backgrounds and half of us come from the tech space, because I do think you need to understand both sides. The answer is we just spend a lot of time with clients. We do 15,000 meetings a year with advisors. We'll meet the average advisor we have a relationship with 4 to 6 times a year. We'll send them, high quality materials. And when we take something like vaults, they have never heard of the term. They want to know how a vault actually works at sort of a base level, like where money goes in, how it goes to somewhere else, how you manage risk, how you monitor the ecosystem, how you make sure the lending pools you're in aren't fully allocated. So they want to understand the nuts and bolts, and it's just a matter of spending a lot of time with them. It's exhausting building a business, but it pays off eventually. So it really is just hand-to-hand combat with people.
I'd imagine vaults to asset managers are a lot like AI to everyone else. Like in the sense that the people that, get caught off guard and fall behind are maybe going to get innovated out of it. But asset managers that utilize vaults, learn about it, try to, incorporate them into their asset management business, are going to end up using them as a tool to further ahead their business.
100%. I mean, look, I think all assets will eventually be managed in vaults. I think vaults will disrupt the traditional fund structure in a really fundamental way. Obviously, they're starting at a small space. They're starting with yield only, but there's nothing about the idea of sort of dematerializing asset management, making it pure IP and execution, that can't be applied to basically every area in the market. I think you'll see the most forward-thinking traditional asset managers follow our and other leads in moving into vaults, right? I think Bitwise is maybe the first sort of traditional asset manager that's building in vaults, but I think others will follow us pretty quickly, because it's the next phase. And like you said, look, we've seen this before. I keep coming up with ETFs because I used to run ETF.com before I joined Bitwise. But when ETFs launched, they were disruptive to mutual funds, and you had some firms that seized on that and some firms who stuck in mutual fund land. And the mutual fund firms are now effectively out of business, or no one talks about them, and everyone is doing ETFs. In 20 years, the same will be true with vaults. It will all be vaults. It's dematerialized asset management. And we're hopeful that this creates a huge opportunity for the people who are first, like Bitwise. Look, we're not BlackRock, but maybe in vaults land, we could become one of the leading providers. At least that's the vision we're pursuing.
Very cool. I want to get an understanding of what you guys are currently doing in vault and what your experience has been, but I can't help. Any chance I get, I want to increase my understanding and experience of the legacy financial world, and coming from that world. I'm curious, why were ETFs so transformative to the legacy financial markets? What did they do to money market funds that caught the MFs, caught them off guard, and why were they so innovative?
Yeah, they had a number of key advantages. So one is that they're more tax efficient. Actually, in a traditional mutual fund, if you and I were in a mutual fund and you decided to sell out of the mutual fund and the stocks in the mutual fund had gone up, I would have to pay taxes at the end of the year because you sold, which is an insane reality. But that was how the old system works, right? The word mutual means like we're all in it together. That sounds great, except for when you sell and I pay your taxes. That's less great. So that was not a good starting point. They also traded intraday, 9:30 to 4 instead of once per day. One of the big ironies to me is all the ETF people are now looking at tokenization and like, we don't need to trade 24/7. I'm like, guys, the mutual fund people said the same thing about ETFs. We don't need to trade 9:30 to 4. Once a day is fine. So they were more liquid. And then after they got to scale, they were cheaper. And that's also something people don't get. Like building a vaults business now is hard. It's complex. The tools are imperfect. It's expensive. Bitwise is losing money on it because we have multiple people doing it. Yes, ETFs were also more expensive than mutual funds. But at the bare metal level, ETFs are a more efficient mechanism for bringing in capital and deploying it than traditional mutual funds. So once you got to a scale, they were cheaper, more tax efficient, and more liquid. And that's why they won. When I look at vaults right now, more expensive, a little corner of the market, sort of annoying. But in the end of the day, it's 24/7. It will end up being much cheaper to run for asset management. And it'll be much easier for people to understand. And I think those advantages will eventually win out.
Yeah. Okay. And what are you guys currently doing in vaults? You mentioned your experience thus far, lost a little bit of money. It's been difficult. It's been, a tech lift. I'm also curious what the material that you're sending out to asset managers, what does that consist of? And what do you find resonates most with those asset managers that might be a little bit more traditional? They're like, I'm hearing a lot about tokenization. I guess I got to learn, I got to read up on it. What is this new vaults thing? How do you help train them and bring them up to speed?
Yeah, sure. So I think you should think about the vault strategy as like two trains moving at different paces. So what Bitwise has done is building like a really conservative prime vault that's lending into morpho pools for collateralized Bitcoin and ETH, right? The most plain vanilla thing. There are other people that are great firms that do a similar thing. The reason Bitwise maybe has a space there is because we're, a registered RIA and we have a certain size and scale and regulatory status and systems. And there will be some people who are using other vaults who may be interested in what Bitwise is doing. That's like a V1. You can imagine that serving that audience, which is mostly a crypto native audience, there will be a V2 of vaults, a V3 of vaults, more complex vaults, taking on more risk, more differentiated exposure. So that's one train. And that's actually like the immediate monetization train, if you will. That's like the business we're serving. The other thing we're doing is we're educating people about what vaults are. They're probably the traditional legacy world. They're probably not going to allocate to vaults in the next couple of years, but they value the relationship with Bitwise. And so introducing them to this area and helping them understand it makes them feel that Bitwise can be their complete crypto provider. If we weren't doing it, someone else would be doing it. And in 2 years, they probably will be allocating to this space. Or if they're Morgan Stanley, maybe they're building in the vault space. They want to know, and they need a steward to know that. And so we are doing that as well. So there's really serving the effectively crypto native audience with high quality vaults from a regulated entity. And then there's educating legacy about what vaults are to build our brand and relationship in the space.
Yep, got it. And so these are the two trains moving at different speeds. Yep, and the ETF industry as a whole has a much higher barrier to entry. And I'm thinking about the progression again, the stepping stone from mutual funds to ETFs to vaults. Given that the barrier of entry to curate one's own vault seems to be much lower than spinning up one's own ETF. Are you worried at all that maybe an asset manager might take this material and say, hey, this sounds great, rather than allocating to Bitwise's vaults, I'm just going to go spin up my own and put all my funds in there?
Bring it. Bring it.
Nice.
I mean, people ask me a similar question about, are you sad that BlackRock is in the market and has such a huge ETF in IBIT when you have been here for 8 years and you only have like a couple $2 billion in BITB? Yes. And my assets are up 15x since BlackRock entered the market. So I'll take it. Right. So look, will traditional asset managers come into vaults? Absolutely. Will they be able to compete for the current users of vaults for whom Bitwise's brand is maybe more resonant than some legacy providers? We'll see. But will they grow the vault space if they come into it? Absolutely. And remember, like the vault space is tiny right now, right? The broader market is measured in hundreds of trillions of dollars. So there's plenty to go. So no, at this point, it's like a rising tide. I think that BlackRock ETF analogy is a good one.
Very cool. And as BlackRock tokenizes more of these ETFs, vaults become more ubiquitous. Composability, I still think is the paramount value proposition of tokenization. Do you anticipate that these vault strategies start to incorporate tokenized ETFs, start to incorporate tokenized treasuries? These things start to become more blended, and we see a lot more of these tokenized structured products end up in vaults?
Yes, absolutely. I think that's the direction of travel. And we're really excited about that. And I think you're going to see vault managers help tokenize products and push that along so that they can use them, particularly as vaults. Well, even when vaults are really focused on yield, but over time, I expect them to expand to other sort of investment objectives as well. So yes, absolutely. And I would add the other angle of the lower cost to entry for vaults is it's cheaper to spin up a new vault. So it's interesting that you mentioned structured products. In legacy finance, structured products are these specialized exposures that are sold to really wealthy clients. They take time and lawyers and fees to build. They're somewhat cumbersome, but they can be very profitable. They can be very interesting. It's so much easier to build novel products in vaults. Like not just the cost to enter, but the cost to innovate is dramatically lower. That I think you're going to see a lot of specialized exposures. My bet is that much of the market will rely on brand. So I think people who build good brands in vault, the Gauntlets, the Steakhouses, hopefully the Bitwises of the world, I think most of the money will go into the top brands and then look at all these interesting sliver strategies, as opposed to just entering the vault space in the wild savannah and having a billion names and trying to pick one. I think they'll aggregate to brand, and then there'll be a billion strategies within brands. That's probably more of the innovation funnel.
I heard you talking about Vanguard vaults. Like the branding of that is just spot on. We like to dabble a little bit in branding ourselves, maybe Bitwise baskets.
I like it. I like it. Let me register the URL.
Yeah, we'll get the marketing team on it after this. Very cool. Yeah, I think this is again just a DeFi primitive that we're going to see spiral upwards in terms of adoption as more tokenized products and tokenized assets come on chain. I think we're also going to see a lot more of the as more of these things happen on chain. It happened much faster than I expected. That BlackRock started to position into Uni, and Apollo started to get positioned into more. I did not think. I thought I figured there was a progression, like you were saying, right? First we tokenize the assets, then these assets become integrated and composable with DeFi, and then you end up buying the governance token, if you will, or the network token, right? You get a stake if you end up really investing heavily into a particular mechanism or protocol. This happened almost in one fell swoop. Did you think this was going to happen so quickly, or why do you think BlackRock and Apollo are choosing to make these activations now versus later, once Clarity Act is enacted, or once it becomes more widely accepted?
Yeah, no, it's wild to me, to be honest. I didn't have it on my bingo card at all. I mean, seeing it makes perfect sense, right? Why did Facebook by Oculus or Insta or whatever, because it was sort of an existential threat to their business, a big new operating system, a big way to onboard customers. I think if you look at Apollo and think about what Morpho means, it makes a lot of sense, particularly at the really low valuation that these protocols are operating in. And then also from a governance perspective, they want to influence the direction of travel for these protocols. So it makes sense, but it was shocking to me. I think I'm still a little stung. Like I'm still, part of my mind is stuck in like the Gensler era, where anything crypto is toxic and large innovative asset managers are like, no way. And I really think we're now not just in a positive era, but in an aggressively positive era, right? We in crypto forget that Paul Atkins, the chair of the SEC, is going on CNBC and saying all assets will be tokenized and move over blockchain-based rails in 5 years. But for BlackRock, Paul Atkins is the most important person in the world. He is saying this is the way the market is going. And so BlackRock is responding by saying, okay, we will go that way. When I think about it that way, it makes perfect sense. I just didn't expect that. I think because I still have this this Gensler anchor dragging me down behind the scenes.
Yeah.
But if you reframe it, it makes a lot of sense.
Well, I think BlackRock is moving faster than really anyone in the typical blockchain startup complex. We're the ones that are used to moving fast and breaking things. I heard you say YOLO shipping earlier, like test and prod. That was the spirit of the industry. And now you have BlackRock moving this quickly because they're listening to the regulators, whereas there's a significant drag that all of us, I think, still feel as a result of Gensler. This, bifurcation between foundations and labs corporations that was created because Gensler pushed pretty much all of these companies offshore, caused, these fugazi foundations to be spun up. Those were the issuing entities of the tokens. And on the other side, you had, real shareholder value and venture capital pouring into labs corps, and all of the value accruing to those equities because it regulatorily couldn't flow to the tokens, which were offshore. And this is still being felt, I think, across the industry. And it's part of why, we haven't seen kind of the catch up that a lot of us would like to see.
Yeah, I think that's exactly right. But I think it's important for people to recognize that they had to do it, right? If you had a way to accrue value, or to put it in regulatory speak, if you could profit from the actions of others, then under the Gensler era, that satisfied the Howey test. You were a security and you went to jail. So you had to build a token that couldn't profit. I mean, right? Like that was the rule. It couldn't profit. And so they didn't. I think the mistake people make now, and you're starting to see this addressed in things like what Aave has done with Avenomics and then with the Aave will win proposal, is the tokenomics can improve. And there is a natural tension in the market where I don't think protocols will succeed if they don't share the value, at least between the labs and the token. And maybe all of the value needs to end up in the token over time, even if they're IP style purchases like we saw in the Aave will win proposal. I think people are maybe making the mistake. They're underestimating how much value these protocol tokens can claim in the future by changing the tokenomics over time. Because again, we have this ghost of Gary Gensler keeping us in a poverty mindset. But I think maybe we're out of that mindset. Maybe we're going to stretch from it.
Yeah. Yeah. The ghost of Gary Gensler, I think is right.
He haunts my dreams, man.
Yeah. That's the article that can go out to asset managers for this educational material. I think you're absolutely right. There was an article that went out by Jake Chervinsky and Jesse Walden of Variant Fund, which kind of put some framing around this. And I think you used the moniker protocol tokens, which is exceptionally accurate, I think, in terms of how the value should accrue, at least according to this article, was that value generated on-chain stays on-chain, accrues to tokens. Value accrued off-chain, generated off-chain, accrues to equity. And, in the case of the Aave will win proposal, we had Stani on the show last week. He was unpacking kind of, what the proposal entails. taking the two buckets. You got the protocol layer. This includes Aave v3, Aave Horizon, a lot of the fees that are built up in that. And then you've got all the IP, the brand, the foundation, the Aave.com, all of that, the Aave mobile app that they're looking to spin up. All of that is in this product layer. I found it interesting after reading, we had Stani on first, then I ended up reading this article. Aave is talking about directing 100% of the revenues being the product layer, the off-chain value accrual, and the protocol layer, the on-chain value. All of that goes to the token. And I'm thinking to myself, if I'm an investor in Aave Labs, I'm pissed. Like, all the revenues going to the token now. They're going to get a lot of subsidies from the DAO treasury, but yeah, where do you stand on this? Is on-chain stays on-chain, off-chain stays off-chain, or is that the right way to think about it? You have a different mental model here.
Yeah, I mean, I like all the value going to the tokens. I think it's simpler and cleaner. There may be a world like a Red Hat style world where a labs entity can do corporate installations on open source protocols. But I like the direction of travel that Aave is going. Obviously, you have to deal. It's a hard situation, right? Like, you've ended up in a hard place. But I do think the ideal starting place, if you had to do it all over again and you were freed from the Gary Gensler constraint, you were starting from budget zero, you would probably just have it all accrue in one place.
Mm-hmm.
Right? You wouldn't have this two-headed Frankenstein. So to the extent that we can get there, even if it's painful, I think that's positive. Now, I'm not an investor in Aave Labs, so I may feel differently if I was on the other side of the spectrum. But I do think, thinking about where you would, like, from a zero budget perspective, how you would design it,
Mm-hmm.
it'd probably just be one thing,
Yeah.
right? And so if we can get there, even if it's painful, and you think this has the potential to 100x from a business entity perspective, then it's worth getting there and solving that challenge.
Yeah. And we talked earlier about one vehicle on multiple venues, which I think is ultimately the place we want to land. Obviously, Aave is approaching it from the token angle. They have the Labs Corp, right, which may go places as well. And then you've got people on the other side. Take BitGo, for example, recently went public, had this native token or native equity that was tradable on chain. Not really, I guess it's a token, kind of. It's still the equity. And so, they're kind of approaching it from the other angle. And so which model does this ultimately get us to the same place? They're just kind of approaching it from different angles.
Yeah, I mean, I think ultimately the idea is unification and single economic exposure. And we were forced into this odd fracturing by a hostile regulatory environment. We still have an uncertain regulatory environment, right? We don't have the Clarity Act. We don't have fixed rules of the road. We have proposals from Atkins, but we don't have detailed regulation. So all of these are sort of early movers in the direction. But ultimately, it's ideal if everything fits into one in most cases, is my view. So I do hope that we get there.
Yeah. And I think ultimately a lot of, there's regulatory reasons to get there now, and people want to unify the liquidity around these things. The investors want, a unified vehicle where they can retain exposure to all of these things. You guys are another one, right? With the vaults, you're generating some revenues on chain, and then you've got plenty of off chain products as well. How are you thinking? People want exposure here, right? Like, I'm not saying Bitwise token, but how are you guys approaching this, internally?
Yeah, it's a great question. It's above my pay grade. You'd have to ask Hunter, our CEO.
We'll get him on. Let's get him on next time.
Let's get him on. Yeah, I'm sure he would love to come on and talk about it. I think it's a fair question, right? Like, from a philosophical view, I think we have a problem with companies staying private too long. I'm not saying Bitwise is in that class, but we do have that problem as a society. I think it would be great to give people earlier exposure. I also think, and maybe this is like not the angle you were going, but I think it's true, that the idea of using equity to incentivize consumer behavior in smart ways is something that society hasn't explored and becomes infinitely easier when we get security tokens. And I wouldn't be surprised to see some interesting experiments along those lines. Yeah, I think that could definitely happen. To make a fun legacy finance point, for what it's worth, Vanguard is actually a collective. It's owned by the shareholders of its funds. It doesn't accrue profits and pay it out to those shareholders, and instead it continually lowers its costs to benefit those shareholders. But it's actually like pretty close to a DAO, which is almost ironic given given their view of crypto. But I do think you're going to see more of those experiments that align sort of shareholder incentives with activity in a company. So I don't know if Bitwise will get there, but I think you'll see other people do it.
Very cool. Yeah, I wasn't aware that Vanguard was structured that way. When when you say it's structured like a collective, I guess the closest that I was thinking was like the Green Bay Packers, I think, are owned by citizens of Green Bay, right?
That's exactly right. Yeah, it's similar to that. So if you own a Vanguard fund, you own Vanguard. And but like owning Green Bay, you don't get profits. Green Bay, you get a cheesehead or something. And in Vanguard, you get to continually lower their fees. That's why their fees are lower than everyone else, because there is no profit layer there, which is interesting.
Yeah, and ultimately, provides a better product and service than a lot of others, on the market. Very, very cool. Matt, I guess as we kind of close out here in the next few minutes, I'm sure, I heard you, discussing some market takes on a couple other podcasts, but I'm not asking you to call bottoms here. I just, I'm curious as far as like how you're thinking of positioning. Actually, what I wanted to ask you was about the DATs. A lot of people are predicting that DATs are going to be like, once they unwind, it's necessary in order for this market to bottom. If the DATs don't capitulate, right, we're not going to go up. How do you feel about, these treasury companies? Do you think it's necessary to shake them out before we go higher?
Well, I think you need to separate DATs. So you have the mega DATs like Strategy or Bitmine or Forward that are missionaries in the space that are completely aligned with their tokens and that have high enterprise value and very low debt. Like even MicroStrategy or Strategy has very low debt compared to their Bitcoin position. I think there's no way an entity like Strategy unwinds in the next 5 to 10 years, and probably ever, because you'd have to have Bitcoin go down 80% and then stay there for 3 years, and then a bunch of other things happen for them to get into trouble. It's just not going to happen. So if we're waiting for them to unwind before we bottom, we should get into another business. It's going to be a long time. Some of these lesser DATs that were late to market, I absolutely think they'll unwind and pivot. But the scale of those are relatively small. So if crypto natives need a body to sacrifice on the altar, I think the DAT gods will offer them up a body at some point. But it won't be like it won't really matter, because it won't be that much Bitcoin that they sell or that much ETH that they sell. So I think it's more a narrative thing. You're not going to get Strategy or Bitmine or others into trouble. Just mechanically, financially, it sort of can't happen.
Sacrifice a DAT at the altar and to the ghost of Gary Gensler, and he washes away all of our.
If that's what it takes, I hope someone raises their hand to be the sacrifice. Let's get it done and move on.
Yeah. And you've also said that, BlackRock, positioning into Uniswap, Apollo into Morpho, these are things that ultimately bring us out of a bear market or a crypto winter. Anything else that you think could be like a big catalyst? Do you think the Clarity Act holds a lot of weight? Anything else that you think, is relevant enough that it could cause some, and at the macro scale too, how much are you paying attention to the new Fed chair, easing monetary policy, these sorts of things as you're, thinking through the investment strategy at Bitwise?
Yeah, absolutely. Look, if you position yourself out 3 years from now and you're looking back and you're like, wow, how did we bottom and then go into a historic bull market? Well, stablecoins went from, $300 billion to $3 trillion. Tokenization went from 20 billion to $200 trillion. BlackRock and others were building in DeFi and buying Morpho and Uniswap tokens. You had quantum risk being put to bed by Bitcoin core developers. Kevin Warsh cut rates more than people expected. Maybe we pass the Clarity Act, maybe we don't. But there's like so many positives. I keep hearing people saying this is worse than 2022 or worse than 2018. That's absolutely ridiculous. There were existential threats then and no positives. When you put all of those things together, oh, look, in 3 years, it will be obvious why we rallied. Those are massive markets. And right now, they're really undervalued. I do think DeFi could lead us out. Like, listen to Apollo, listen to BlackRock, look at these valuations. Like, Morpho's $1.5 billion, largest credit fund. They want to have a stake in it. It's not going to look that complex a few years from now. So, yes, there are a ton of catalysts, but bottoms always round out. It's never V-shaped. So it's not like the Clarity is going to pass. Clarity Act's going to pass, and we're going to be back to 100,000. It's not what's going to happen. It's going to be this accumulation of good news that gets ignored until it's so weighty that it's just obvious, and then we'll be at new all-time highs.
Mm-hmm. Yeah, I think that's a prudent approach. Matt, last question I got for you is, we've been thinking a lot about where the space is heading. You've been around for multiple cycles. We've been around creating educational content in the space for multiple cycles. It feels like finally these institutions are being forced to innovate. They're evolving, and then at the same time, a lot of DeFi is starting to find some product market fit. There's a lot of infrastructure that never really found product market fit. Maybe they never do. They're being forced to innovate as well. Where these things are meeting is it looks a lot different. It's not really seed phrases and self-custody. People want forgot password buttons and customer service. They also, they want a neobank approach. They want vaults. They want tokenization and composability. We're calling this neo-finance. And we think it has to be something that, not DeFi 1.0, 2.0. We've done that, right? Like, we're trying to come up with what we think the new moniker is. I'm just curious, do you think this is the right way to think about it? Would we see Neo Finance go out to some asset managers and Bitwise educational material? What do you think is the right mental model? How do you think about Neo Finance?
I like that. I like the term. I do think we're reinventing finance. I think it's way overdue. Fintech has effectively been a failure. Finance is the least disrupted sector in the economy. The largest financial services company in the US was created in the 1700s. That's like embarrassing. So I do like the idea of neo finance. I think it is important to get out of crypto specific terms. Mm-hmm. Crypto terms are limiting. Even decentralized is relatively limiting. And many crypto terms are actually negative in the real world, like trustless sounds bad. Mm-hmm. Even zero knowledge proofs no one wants zero knowledge, sounds bad. So yeah, I like neo finance. I do think the scale of it is right. Yeah, ultimately the scale is like vaults take all of asset management. Stablecoins take all of payments. On-chain lending markets replace all of lending. I think that's the scale that we're going. So something like neo finance is a pretty good term.
Awesome. Appreciate you saying that, and appreciate you coming on today. It was a pleasure. Would love to have you on again, in a couple months to reassess where we are at. Hopefully in the crypto spring and the neo finance next era, I guess.
I love it. I love it. We'll do it for sure.
Awesome. Thanks so much, man. Really appreciate it.
Thanks for having me.
Awesome. There he is. That was Matt Hougan, CIO at Bitwise. Absolute pleasure of a conversation. The guy's a great guy. Very, very smart. I'm sure you guys have seen his takes online. We're gonna have a bunch of clips coming out as a result of this. You guys heard his take on neo finance there at the very end. This one went deep. Obviously, we talked tokenized equities, tokenized everything. Matt believes everything is going to be tokenized. And he's actually talking to the asset managers and the institutions. So I think he's in the right place with the right knowledge. Look, BlackRock is tokenizing all of their ETFs. We're going to see how that evolves. These things are going to become collateral and assets within these vaults. It's going to be so many of these vaults. You're going to have so much expressiveness. You can pretty much get access and exposure to anything you want. I'd even suggest maybe a Bitwise equity token, something collective. We'll see. Absolutely great conversation. Difference between equity and token as well. And then obviously, we went deep on a lot of the legacy financial aspects as well, which is important to understand, especially as a builder in today's day and age on blockchain rails, as we're applying a lot of these assets and financial infrastructure to our blockchain and digital asset ecosystems. So, guys, that's it. Pleasure. We are going to be live tomorrow on AI, which we didn't cover too much with Matt, but we're going to have a whole special episode about AI tomorrow with our friends at Near live from ETH Denver. I'm flying there later tonight. I heard it's going to snow, so hopefully my plane lands. That's it. Cheers, guys. See you tomorrow.